Good morning and welcome to part 2 of Buzzacott and Stone King's Academies annual update. I'm your host for today, Stephen Ravenscroft, and I'm a partner at Stone King. And this is part 2 when our colleagues at Buzzacott will be looking at the Academy's financial and reporting update. And I'm very pleased this morning to be joined by Catherine Biscoe, Hugh Swainson and Catherine Patel, who will be taking us through the update for you. Just before we get going, just a couple of points of housekeeping. As webinar attendees, your webcams and microphone are turned off. Please do ask questions. You can do that at any time using the Q&A function on the right-hand side of your screens. All questions will come directly to us. And for your privacy, when we reach the Q&A section of the event, all questions will be kept anonymous. The webinar is also being recorded, and a copy of this recording will be sent to you along with the slide deck, so you would then be able to review it and share it with any colleagues after the event. So without any further ado, I'm going to hand over. We could move to the next slide just so that we can broad overview of the day. Catherine is going to have a quick look at the Academy's accounts direction and updates for that. Hugh will be reviewing the governance statement and updates there, and Catherine Patel will be finishing off by going through going concern and reserves issues. We're aiming to have a period of 5 or so minutes at the end for Q&A, but if we're unable to get through all of the questions that are asked, we will follow up separately with answers to the various questions that have been raised, again on an anonymised basis. So without any further ado, over to you, Catherine, an update on the Academy's accounts direction. Thank you.
Great. Thank you very much, Stephen. I'm very pleased to see you all today, virtually, or actually not seeing you given it's a webinar, but to be speaking to you. So I'm going to be covering the changes arising in the accounts direction this year. So if we can just move on to my first slide. The accounts direction was issued by the SFA on 31st of March, and as you would expect, applies for accounting periods ending 31st of August this year. So really just a reminder here that the board, obviously as part of their responsibilities, they are responsible for putting together the annual report and the financial statements each year for the Academy Trust, and these do need to be prepared in accordance with the Academy's accounts direction. So really just a reminder here that the status of the accounts direction is mandatory for all types of trust. And as you know, really the direction really includes the guidance set out in UK GAAP, so really that's FRS 102 and the charities SORP, but is really adapted in terms of how that applies specifically to Academy trusts and the additional ESFA requirements over a number of those aspects in the financial statements. You will be pleased to hear that there are only a few minor updates to the Academy's accounts direction this year. So on the whole, the format of your report and accounts will be quite consistent with the prior year. However, what they have done is the ESFA has actually looked at the structure of the document, and there's a bit of a revision as to how that's structured. And there's also a lot more reference throughout to their ESFA's good practice guides. And then the final point really just to note is that as they did last year, the ESFA do intend to publish a supplementary bulletin to the accounts direction to cover the sort of reporting and auditing matters to do with COVID and the pandemic. So if we move on to my next slide, looking initially, as I said, at the structure of the accounts direction this year. So as you know, previously this was just the one single document. What they've done for 2020-21 is that it's now been split into sort of 3 elements. So you have the sort of the primary accounts direction, and really this is the section that includes the sort of the technical guidance, really the explanations around the treatment for the various transactions within the financial statements. You then have the model set of accounts for an Academy Trust, so what's called the Coketown model. So this is a really useful document. It's now sort of a separate document, so you really can refer to this quite easily as you're putting together your report and accounts for the year. And then there's now also a third section, which is what they're calling the auditor framework and guide. And this is really primarily for use by Academy Trust's sort of external auditors, reporting accountants, obviously for regularity purposes. But I think it's also sort of worth a look for yourselves in an Academy Trust, because it really, gives you a bit of an indication as to what your auditors will be looking for as part of the year-end process. And then, as I said at the outset, really the direction now is also making greater use of sort of referring to the ESFA's good practice guides. So really throughout the document, drawing attention to these where relevant, sort of setting out the best practice for Academy Trusts. So if we move on to my next slide, really the changes, as I said, to the accounts direction this year have been quite minimal. So just a change to the financial review section in the trustees report, and then some changes to some of the disclosure notes to the financial statements. In terms of the changes to the report, there have been 2 changes that have been introduced, and they're really all within the financial review section. So really thinking about these as you're putting that part of the annual report together. So the first section is the first change, is really to provide that additional guidance, that additional clarity on what this section should contain in terms of content. So I think in some cases what had been included here, the SFA was perceiving was possibly a little bit light. So really to give a bit more information here. And also obviously it's the financial section, but making sure that when you're pulling this together, the terminology that you're using can be understood by a non-accountant. So there are some must requirements and also some should requirements. So looking at those must requirements first, you need to be able to sort of set out the financial effect of significant events on the financial performance and position of the trust in the year. So I'm sure COVID, the pandemic, continues to be a significant event, but there might be other things. So you may have had a flood or something in say your sixth form centre building. So what impact has that had on the sort of financials of the trust for the year? You also need to look at the principal risks and uncertainties that you're exposed to as a trust, and sort of what mitigating actions are performed, making sure you're talking about that in your financial review. Also looking at sort of key factors that are likely to affect your performance and position going forward. So you would normally have your section on future plans, but I think making sure that any financial implications of those plans are addressed in this financial review section. And then you need to set out, the financial position of the trust at the balance sheet date, and give any context as needed to some of those key figures, those material figures on the balance sheet or in the funds. If you do have, as a trust, a subsidiary that is in deficit, then you do need to also set out the circumstances that have given rise to that deficit and what you're doing as a trust in order to eliminate it. So then on the next slide, moving on to the should requirements. So again, this is obviously best practice to be including it. So explaining here main causes, key factors that have underlying the financial result for the year. So, if you've sort of received, you've made a bigger profit maybe than you had anticipated, than you'd submitted in your sort of budget return, and maybe that's because of a sort of a one-off donation, something like that, making sure that that's properly explained and addressed in this section. Also, obviously, looking at the key sources of funding that you receive as a trust, and how these different sources of funding are sort of helping you support your objectives as a trust. Your investment policy. So if you are a trust that does hold investments because of surplus funds, if these are material, then you do need to go into a bit more detail here and sort of set out how your policy will address things like the social, environmental and sort of ethical considerations. And then also a description of your fundraising practices. So again, this is in line with the sort of the Charities Act guidance. Obviously, we know a lot of trusts are doing a lot more sort of wider fundraising. So making sure that your sort of practices and policies are properly sort of set out here in the report. And then the second change there, just at the end of the slide, is only applicable if you have received a financial notice to improve from the SFA, and that's sort of been in place for part of the year. So if that's the case, you need to state this and sort of what period it was applicable for in your report. You need to provide a link to the notice on the ESFA's website, and you need to explain what you're doing to address this. And if it is still open at the balance sheet date, then you need to sort of set out what your expectations are in terms of timing when you think that you will have met all the conditions and therefore it will be lifted. So that's it on the report side of things. Moving on to the next slide, just a few changes to disclosures in the financial statements notes. So no changes to the sort of the main SOFA and balance sheet primary statements. So looking first at the staff disclosures note, so here this is looking at where an Academy Trust might have some off-payroll arrangements. So this is obviously people that are working for the Trust but not in an employee capacity. And this can include, if you have sought a sort of specific ESFA permission for it, accounting officer or chief financial officer, but obviously is not limited just to those roles. And so if this is the case, if this is something you're doing in your Trust, you need to set out the amount that you have paid to these people in this role in the staff cost disclosure note as if they were an employee. And additionally, you also need to report this for the prior year. So you would have to restate this potentially if this is an arrangement that's sort of been ongoing for longer than just the current year. The next note that's impacted is the one that sort of discloses the funding received by the Academy Trust for its educational operations. So this tends to be note 4 in your accounts. It's certainly note 4 in the Coketown model. And here it's really just around clarification as to sort of which headings the sort of various funding sources should be classified under. And the reason here is really to sort of allow that greater alignment between the financial statements of an Academy Trust and then the way you have to present that information in your Academy's accounts return later on. So if you look at the Coketown model in note 4, you will see that sort of broken down quite clearly. So you have your sort of DFE, ESFA grants, obviously GAG shown separately. Any other ESFA grants that are individually material need to be shown separately. Anything else then from the ESFA can be grouped together as other. And then the change here is that the other DFE group sort of category is for grants received from agencies or public bodies which support the DFE, and this is where some trusts may see a change. So things like, for example, universal infant preschool meals may have previously been under the other DFE group heading and now would be shown separately above. And if that is the case, you need to just add a bit of disclosure below the note to explain that. But the example in Coketown is very clear. Leases, the next note, really just a reminder here to trusts that they need to make sure that they can correctly differentiate between operating and finance leases, and the direction also draws particular attention to the possibility of embedded leases being present within other sort of contracts, so things like catering contracts. And again here, this is an area where you may want to also refer to the ESFA's Good Practice Guide on leases, which gives sort of a lot more information and explanation in this area. And then the final point just on long-term commitments, this may not apply to many trusts, but just a clarification has been added that any sort of service concession commitments, so most likely PFI agreements, these are actually long-term contracts, should therefore be disclosed, long-term commitments should therefore be disclosed as part of that long-term commitments note. And again, there's been additional guidance provided so that it's easier for trusts to sort of identify these type of agreements. So that is it in terms of the accounts direction. Not too much change really, but onto my next slide, what I just wanted to look at was some of the changes we're expecting in the COVID-19 supplementary bulletin. So obviously, as last year we saw one that was issued, the SFA do plan to issue a supplementary bulletin again this year. So really, so that they can address the sort of impact of the pandemic on the trust's financial statements and audit kind of separately from the main accounts direction. This has yet to be issued, as I said, but what we've put on this slide is really some of our expectations. So this is based on what was included last year, because we have been told that the SFA intend to sort of follow a similar sort of format and content, but also sector discussions and discussions with ESFA as part of attendance at working group meetings. So the first point, really just to note that when it is issued, it will have the same status as the accounts direction, even though it's a separate document. So therefore, compliance with it is also mandatory for trusts. again, in terms of what we would expect, so in the report section of your accounts, again, we're still expecting the ESFA to be sort of wanting you to include some reference to the impact that COVID has had on the activities of the trust in the year. So similar to last year, obviously the impact has been different, but still obviously worthy of mention. I think the section we'd expect this in particular would be the financial review section. So really impact of the pandemic on financial performance, reserves, you know, impact of any additional COVID funding you've received, how you've been spending that, what it's enabled you to do. Of course, you know, financial risk and uncertainty and how that impacts your going concern assessment. That's going to be the key one, but I won't dwell on that because that's the section which Kath will be covering later on in the webinar. We'd also expect to see reference to the impact of COVID within the governance statement, so particularly what impact this has had on the Academies Trust governance arrangements, its risk mitigation, and so on. Other than the reports, obviously you will recall last year in the bulletin there was guidance on the treatment of any additional COVID funding from ESFA, also HMRC's coronavirus job retention scheme in terms of the income recognition for that funding and the separate disclosure that was required there, including also the disclosure of associated costs. So again, we're expecting similar guidance this year, obviously more varied sort of COVID additional funding available this year. So things like catch-up premium, for example. We haven't seen the guidance yet, but we're expecting obviously that the SFA will be sort of addressing these in turn in terms of what additional separate disclosure might be required for the different funding streams. Also, the bulletin last year clarified that there were no additional disclosures required for the free school meals support, so we would expect that to remain the case this year. And also we're aware that the SFA are looking into the sort of the accounting for laptops and other devices that have been received by trusts and then sort of passed on for use by the pupils, disadvantaged pupils, so that they could access remote learning. So we wait to see what the SFA's stance on this will be, but obviously the direction has got to follow FRS 102 and charity SORP principles. So we'd expect that the current considerations here would be sort of around, you know, if these laptops have been donated to the trust, what's an appropriate valuation for these donated assets? When these have then been passed on to pupils, have they been given to the children or have they been lent? And therefore, you know, who retains the risk and rewards of the asset, therefore will determine whether the trust includes that as an asset or not. So those kind of areas we expect clarification on from the ESFA. And then also just finally, we would expect again guidance in the bulletin of the impact of COVID on our audit. So both for the financial statements and making sure really, I guess it'll be reiterating the need for quality of audit and the fact that, you know, the difficulties of the pandemic and remote working on both trusts and auditors is no excuse for reduction in quality. So that was really pushed last year and also by FRC. And then again, with regards to regularity, and in particular, you will recall here, it was quite a bit of focus around value for money, compliance with procurement policy notes and so on. So we expect to see further guidance there too. And really that concludes my sort of whiz through the changes that we can expect to see in your report and accounts this year, both obviously those that we confirmed and we know about in the direction, but also what we're expecting from the imminent COVID bulletin. So thank you very much, and I will hand over to Hugh.
Thank you, Catherine. So this section, going on to my next slide, is going to focus on the governance statement. So the accounts for Academies are based upon the charity statement of recommended practice, but then there's a whole number of other areas that are built on top of that the ESFA specifically required. So the majority of the accounts, including the trustees report and the financial statements, look relatively similar to a charity set of accounts, but the governance statement is entirely separate. That doesn't appear in a standard charity set of accounts. This is specific for Academy trusts, and really the governance statement is there because Academy trusts use public money. And it's making sure that those governance arrangements, that management of risk, internal control, internal scrutiny is all there and in place for Academy trusts and reporting on that. So what does the governance statement include? It gives an overview of the governance, so details of the board and the subcommittees and the people who are part of those. There's a value for money statement as well. This is probably one of the more free-form areas of the governance statement. There's different interpretations of value for money and approaches to it. So that's an area I'm not going to concentrate on as much here. And then there's the risk and internal control sections talking about risk management, how you oversee internal controls, and then the internal scrutiny aspects. There's no big changes to the governance statement this year in the accounts direction. However, they have highlighted a number of areas where there's common omissions from a lot of Academy trusts, and so I've highlighted those in orange throughout the slides. Just to note also that the Academy's financial handbook has now been updated and recently released this week. They've actually renamed it the Academy Trust Handbook rather than the Academy's financial handbook to recognise the fact that it's got a broader scope than just the finances. Through these slides, I'm going to refer to it as in a few places, and I'm going to talk about it as the Academy's financial handbook, just so as to not confuse it with the governance handbook and other handbooks. So on to my next slide. One of the first things you'll see within the governance statement is a request for to include information on whether the trustees have taken into account the DfE's governance handbook and competency framework. It's not mandatory to make this statement, so it's only if the trustees have taken this into account. But I think it's well worth having a look at what that governance handbook and competency framework includes. Obviously, a lot of the requirements that the DfE has around governance come from that financial handbook, but the governance handbook really sets out the DfE's priorities for effective trust governance and really gives us therefore a lot of insight into what the department is looking for, and we can see very strong links for what is in that governance handbook and what's required in the governance statement and what's the ESFA might be looking for in the governance statement in terms of statements. So it's well worth having a look through that. So I'm just going to pick up some of the key points here. The current edition of the governance handbook is October 2020. There's quite a few changes in that. A lot of them are sort of very detailed changes, but you can see some of the key themes of recent years in the financial handbook coming through. So things like the emphasis on clerking in the handbook. So really, I think there's been a sort of recognition perhaps over recent years that there's needed a strengthening in clerking across the Academy trust sector, and they're really promoting good practice in that area now within the financial handbook and the governance handbook here in terms of the ability of the clerk to support the board, to make things organised, smooth, give procedural advice, that side of things. Interestingly, in the financial handbook this year, they've changed the terminology from clerking to governance professionals, probably recognising the fact that a lot of the sort of, especially the larger multi-academy trusts, have a head of governance or equivalent within the organisation. And there's also this emphasis, increased emphasis on members and the role of members, which again we've seen come through the financial handbook in recent years, particularly around things like the separation between trustees and members, and making sure that trusts have a minimum of 3 members and encouraging to have at least 5. But the governance handbook itself is set out around 6 key features around strategic leadership, accountability, people, structures, compliance and evaluation. I'll come on in a second and talk more about those. But just accompanying that governance handbook, there's 2 other competency frameworks, one for clerking and the others around the competency framework for governance. And that again builds around these 6 themes and explains the competencies and skills that you'd expect to see at a governance level. So over to my next slide, just exploring those 6 key themes, because I think a lot of these key themes you can see coming through in the governance statement within the accounts. So the first one, strategic leadership, the importance of setting the direction, the culture, values and ethos of the trust and the decision making. It also talks about stakeholder engagement and with the community. One thing, interestingly, in the financial handbook this year that we're seeing is a new emphasis on parent governors and making sure there's 2 parent governors provided, either if it's a SAT in the governing body or in a MAT, it could be either at the board or the local governing body level. The second area is on accountability. So this is about the sort of relationship with the executive, challenging the executive, senior executive staff, the sort of oversight of both educational performance and non-financial performance. And interestingly, it talks about data, and this is something we'll see come through in the governance statement. It's saying the importance that the board looks at and analyses sort of robust data as part of its role. Third area is looking at people, so making sure that there's an effective team and the right sort of skills mix of people at the governance level. Structures, that's more looking at the board and its subcommittees, how they interact, potentially structures for MATs such as local governing bodies and how all of that's put together with the delegation of authority. The compliance side is looking at a whole range of things, not just the financial compliance with around things like the financial handbook, but looking at sort of broader compliance such as safeguarding, health and safety, whistleblowing, all of those kind of issues. And I think in recognition of that, that's one of the key reasons it's gone from being called the financial handbook just to the trust handbook, because it's now looking more broadly at those areas. And you can see some of the new areas in the handbook this year are areas such as references to guidance on safeguarding, health and safety, those kind of areas. And finally, evaluation, the importance of self-review and reviewing the governance arrangements in place and whether the board is effective, and we certainly see that coming through. So well worth being aware of that governance handbook and the key themes there, because it may give you ideas about what to include in your governance statement in terms of the narrative. So over to the next slide. What are some of the key things that we've got in the governance statement? One of the first things you'll see is there's a list of all the board members and their attendance at meetings, so how many meetings each of the board members attended. And then underneath that table, there's a number of requirements, and these are probably some of the more open to interpretation requirements within this section of the governance statement, and they probably receive very variable responses because this is an area where they've highlighted a lot, where trusts have omitted things. So what are they looking for underneath that table of the trustees? They're looking for some narrative on the key changes in the composition of the board. I think probably a lot of Academy trusts have interpreted this as they've got details of the board and when appointments and resignations have happened. But I think they're looking for more information here around in a narrative sense around changes in the composition of the board. And I think this goes back, if we look at the governance handbook, to talking about people and how the board's making sure it's got the full complement of people, the right skill set, and the key things in the composition of the board. It also talks about the coverage of its work, and again it's highlighted a lot of Academy trusts are omitting to talk about the coverage of the board's work. It gives very little definition of what this means. In the accounts direction, it does highlight that this should be included if it's not included in other sections of the annual report. So I think it's sort of implying it may be covered by sections that talk about the overall governance arrangements, what's covered at board level, what happens with subcommittees, the structure with local governing bodies, and that kind of thing. But they have specifically highlighted, so it's worth making sure you're responding to that requirement. It talks about the board's performance, including assessment of its own effectiveness. So this whole area about board effectiveness is really important in this area. And it also talks about particular challenges that may have arisen for the board. We can see in a couple of places in the governance statement, they're sort of seem to be looking for a balanced report where you're talking about, you know, whether things are effective, whether there's areas for improvement. Obviously, you know, very difficult when you're putting things on public record to get the right balance of that, but that's what they seem to be encouraging. And information about the quality of data used by the board. So this comes back to this thing in the governance handbook around the importance of data. So again, difficult one to know exactly where to concentrate. There's all sorts of different data that the board will receive, whether it's financial or on educational outcomes, that kind of thing. But I think probably some statements that the board has made sure it's receiving robust data and scrutinising, analysing that is important. Then after that section, it then wants you to talk about governance reviews. And so this is a key feature. It says new Academy trusts must carry out a governance review in their first year, but even established Academy trusts should do this on an annual basis. So it's saying should rather than must there. But it does sort of give you effectively the option there to say self-evaluation or an external governance review. Interestingly, in the latest financial handbook, it does promote the benefits of an external governance review. And again, on the emissions here, this talking about effectiveness and governance review is something they've talked about emissions. So there seems to be a sort of push this year to encourage a bigger focus on governance review, and also to explain if you haven't had that when the trust next intends to do so. It also said that the board must meet at least 3 times a year and should explain if it meets less than 6 times a year. I haven't really seen any that have met less than 3 times a year, so that's a must. But I have seen plenty that meet less than 6 times a year, and normally the reason for that is because there's a subcommittee structure in place. And I think it's becoming the norm now to explain that, you know, if you've got a subcommittee and your finance and audit committee are meeting multiple times a year, that fits into you know, a large number of meetings, but just to explain how you've met that requirement if you've met less than 6 times a year is important. Over on my next slide, I'm going to look at the risk and internal control framework section. So there's a number of standard statements around things like risk management, internal control, that often Academy trusts don't vary unless there's any big issues arise and big weaknesses there. So I think the area where there's most variability and is probably around the bit around internal scrutiny, and that's certainly what the ESFA is picking up on. So that's the bit I'm going to concentrate on here. Just before I get to that, a bit of a background to where we're at with internal scrutiny, because it has changed a lot in recent years for Academy trusts. Just a reminder, there are 4 options around internal scrutiny set out in the financial handbook. So having an employed internal auditor, and internal audit service brought in, checks by a trustee or a peer review by another Academy trust. So quite a lot of flexibility there, and I think that flexibility reflects the diversity of the sector. So obviously checks by a trustee isn't going to be appropriate for a large multi-academy trust. Equally, a single primary Academy trust is not going to employ an internal auditor. So there's a whole variety there. The financial handbook this year does highlight that the internal audit, if it's in-house, shouldn't be done by members of the senior executive team. So I think that's reflecting the fact that obviously people like the CFO do checks on the finances and risks within the Academy trust. But internal scrutiny is fundamentally separate to that. It's another layer of scrutiny and shouldn't be relying purely on the checks done by management in that respect. The internal scrutiny for Academy trusts is guided by a separate good practice guide. So if you just Google ESFA internal scrutiny guidance, you'll see this guide which sets out the more detailed expectations around internal scrutiny and the purpose of internal scrutiny to provide the board with assurance that the trust systems of controls are effective. And it gives examples of the kind of financial and non-financial areas that trusts might want to review. I think with Academy trusts, often there's because of where internal scrutiny's come from, where it used to be this sort of responsible officer checking just some core financial controls, there can be a sense that, it doesn't do a lot different to what's being done in internal, in the external audit. However, I think it's evolved a lot in recent years, and really what we're looking at now is that, ultimately Academy trusts are spending a lot of public money, and the board needs to, and the audit committee in particular, needs to get assurance that things are working as they should be, funds are being spent appropriately, there's regularity, propriety and best practice in place. So if you're looking at things like, say, you've got a new payroll system in place, is that working well? Or cybersecurity risks, the new financial handbook, really flags up trusts being aware of that cybersecurity risk. How do you know that that's being managed? Are your budgeting processes good? All these questions that audit committees may ask. The internal scrutiny is an opportunity to get assurance in there, so that the trust gets that level of assurance over the trust processes and use of public money. So what's actually included in the governance statement? A number of disclosure requirements talking about the details of the areas that are covered by internal scrutiny in the year, what arrangements have been in place, what reporting's happened. So just giving the reader confidence that there's been sort of regular reporting to the audit committee and they've seen the outcomes of the internal scrutiny. Obviously, whether the programme of work has been delivered as planned. So that's particularly important in these times of COVID, where there has been disruption. They've recognised to the internal scrutiny programmes. And again, details of material issues and remedial actions taken. So again, it's that sort of balanced review. What kind of things have actually come out of this? What lessons have learned? And that's an area where they're again highlighting that a lot of trusts have omitted this, not talked about those remedial actions taken. So I think it's probably a bit of interpretation here. How material does something have to be before you put it in your governance statement? I think again they're encouraging quite a balanced review and talking about sort of continuous improvement. And more broadly, they've talked about that there's not enough around the details of how the internal scrutiny function has been delivered. So I think it's just more information they're wanting here. It's often been kept quite brief. I think they're just wanting a fuller picture within the governance statement around internal scrutiny going forward. I think that's everything from me. So now I'm going to hand over to Catherine to talk about going concern.
Brilliant. Thanks very much, Hugh. So yes, I'm going to look at a couple of more detailed areas, going concern and reserves, and I guess both of which are very much interlinked, linking to the overall financial viability of trusts, but also particularly important at the moment, given COVID, the impact of COVID over the past 18 months, ESFA levels of scrutiny, the financial position of some trusts, and also the potential future opportunities for growth of trusts as well. And as I said, going concern and reserves very much interlinked. So if we go into the first slide, please. So starting off with going concern, and really looking at some of those underlying principles here. So it is very much an accounting and an auditing term, and it's all around the question around whether the organisation has sufficient funds in order to pay its obligations, so payroll, creditors, etc., as they fall due. So linked very much to the solvency of the trust, the liquidity of the trust's assets as well. So very much focusing on those cash levels, deposits, the liquid assets, the working capital levels, and that focus on future cash flows for the Academy Trust as well. In terms of a pure accounting concept relating to going concern, we're looking at the period at least 12 months from the date of approval of the financial statements. So that doesn't mean it's a sort of a one-off review, but very much from the concept of your accounts, your financial statements and audit, we're looking at that 12-month period. So basically for this year's accounts, assuming sign off by the board in December, we'd be looking through at your cash flow projections, etc., forecasts through to at least December 2022. As I mentioned, cash flow really being key here. So there may be on your balance sheet, you'll have pension reserves, pension deficits that are negative. You'll have your fixed assets, your capital reserves in there, but really from the point of assessing going concern, it's very much linked to your operational position, your working capital and your cash flow. So you could have ultimately a net liability position overall. Potentially you're a church, Matt, that doesn't have your land and buildings on the balance sheet, but you have the pension liability. You could have a net liability position, but actually you can still maintain your cash flow, your working capital, and future cash flow forecasts are positive and strong, and therefore you remain solvent. So increasing focus on this area for a number of reasons, really, and that's really come through over the prior year as well. Obviously, COVID, as we've mentioned, the Financial Reporting Council issued further guidance for organisations and auditors in the previous year, and obviously the ESFA focuses on this area very heavily as well. So requirements set within the Academies accounts direction. So the trustees, the requirement for trustees, particularly within the trustees report and the accounting policies, to set out their conclusion on going concern and some of the key points that have led them to that conclusion. Normally saying that they're happy that the organisation, the trust, is a going concern. Obviously, if there are uncertainties there, they should also be flagging those uncertainties within the accounting policies. And the broad responsibilities also within the Academy's financial handbook as well. I couldn't see anything significantly different within the 2021 handbook, but very much here still a very much clear responsibility for the trustees. And we've also had this year for the first time a revised auditing standard relating to going concern. We've always done work in this area, but there is a bit of further focus on this, and I'll come on to this in a subsequent slide. And really this is all collated, very much a really useful good practice guide issued by the ESFA. It's recently been updated, so that the good practice guide relating to operating an Academy trust as a going concern. So some really useful points coming through in that, and I'll come on to some of those as well. One of the points coming through in there that's just worth mentioning is it really emphasises the fact that even though as a trust you will have secure funding streams coming through, you know your GAG funding will come through based on pupil numbers in future years, that's not sufficient in order to conclude that you're a going concern. You could ultimately have liquidity issues if your working capital levels, your cash flow is not adequate going forward, even in the shorter term. Also worth noting here that if there are going concern issues being flagged, the accounts can flag these to the ESFA, but obviously likely to result in ESFA intervention, and that will probably arise before the annual accounts are filed with them, but potentially here notices to improve, additional scrutiny, recovery plans as well. So something very much in the ESFA's mind as well. So if we just move on to the next slide, what I've set out here is really, because ultimately this is the trustees' responsibility to assess going concern, really just some of the key points that are coming through in the best practice guides and the types of areas that trustees should be considering. So as I said, it's the trustee statement within the accounts on going concern. Obviously that assessment has to be proportional to the complexities, to the issues being faced by the individual trust. It will be different for a large MAT in comparison to a single Academy trust. What are your current cash levels? What are the demands on cash going forward? So where are some of the uncertainties? We're seeing some of the London schools at the moment, trusts facing demographic issues in terms of future pupil numbers. How does that impact? Probably not in the next 12 months, but how does that impact on your future solvency and liquidity as a trust? Estate capital demands as well. What are your schools looking like in terms of the need for investment? How likely is it that they will be funded by the SCA or SIF bids, for example? And really building in to your risk assessments as part of your risk management process, those liquidity and solvency factors as well. Where are the risks? You may conclude this is lower risk, and that's where the sort of degree of proportionality comes in, but very much something that must be considered. The ESFA also emphasises this is a continuous process, so this isn't something you should be doing just once a year when you approve your accounts. This is continuous. It's a rolling review. Consideration where that sits within the trust as well. So I would guess that the Finance Committee is probably best suited to do some of that detailed review, but not forgetting that this is an overall board responsibility. So the full board must be aware of any risks in relation to this, and also in signing off that final conclusion as well. I think absolutely critical, and this comes through very strongly in the SFA's guidance, is the level of challenge and scrutiny that the trustees via subcommittees potentially are giving. Do you have the correct skills and knowledge base across your board or on your committees in order to challenge those assumptions that are being made within your financial forecasts, within the cash flow forecasts? It's very much something that the trustees should be interrogating the financial management team on, and being happy that there's a robust process. So the types of things that you would be looking for and looking for from your finance team and management team, you see the monthly management accounts that are coming through, those future cash flow forecasts, always looking at it for an extended period, not just necessarily to the next year end. I would continue that to at least 12 months from the current month end. Looking at the assumptions as well, so this is where the degree of challenge can come in, and obviously as auditors that's some of the areas that we'll be looking at as well. But in terms of those pupil numbers, have you correctly reflected current contract commitments, PFI, payroll, future increases in pensions, for example, and that's also being factored into the financial forecast, the longer term financial forecasts. What action do you need to take now in order to make sure that the trust is viable in future years? The ESFA also in their guide also draws that definition between the short term and the longer term financial planning, saying that from a going concern account sign off, you might be looking at that short term element, but very much that you should also be considering the 3 to 5 year profile, the longer term financial planning. And actually Annex A of the Good Practice Guide has basically 2 columns, short-term questions that trustees should be asking of the CFO, and equally the longer term questions and considerations for financial planning. So I think really worth all trusts looking at that, finance committees and boards really looking at that to check they're happy that all of those requirements are being met. This obviously feeds into the reserves policy. What is your target level of reserves? What level of operational reserves does the trust need, normally excluding the capital element of this? So I'll come on to reserves in a second, but very much interlinked. Reserves are key in order to ensure that future financial viability. And I just put a reminder here in terms of that fact that you must notify the ESFA if you are proposing a deficit revenue budget, which is using those brought forward funds, operational reserves from prior years, then you must be notifying the ESFA. Again, this is a flag to them that potentially there are some issues relating to the financial sustainability of a trust. If we just go on to the final slide on going concern, so really here I've set out the audit implications for this, and I won't go into too much of the technical detail, but this is a revision to the auditing standard 570. As I said, going concern has always been an area of review and scrutiny for auditors, but there is now, under the revised auditing standard, an increase in focus. And there's more here about understanding the board's process, the management team's process for forecasting, financial planning, budgeting, cash flow monitoring. So it's more present throughout the audit rather than that assessment at sign-off that would traditionally have been done. And I guess it really has stemmed from, as you'll all be aware, quite a number of the sort of well-publicised corporate failures have drawn attention to potentially a lack of auditors' work, poor judgment in these areas. And actually what that's leading to this year is that we'll be giving a positive opinion now on going concern within our audit report. So previously we would have more or less reported by exception. We would have flagged if we felt there were material uncertainties. We'll now be saying, assuming the trustees are concluding that the entity is a going concern and we agree, we will be giving a positive statement to say that we agree with the trustees' assessment of going concern. But if there are material uncertainties, very much flagging those within the audit report as well. So really, increased work here to challenge the trustees' assessment of going concern, really looking at those assumptions that the trustees are making, that the management team have made within your financial forecasts, and focusing on the cash flow side of things through that 12-month period and beyond as well. And really to look here at the documents really that I've mentioned already, but in terms of budgets, forecasts, your returns that have been submitted to the ESFA and the assumptions that are being made within those. One approach that we're suggesting to some of our clients is, and particularly where going concern may need a bit more review, or the trustees want to really think about how they're documenting this, is to really have a paper that goes to the Finance or Audit Committee, really demonstrating the considerations the trustees have made. We've sort of set up a template paper that can be useful to go to the committee even earlier than the accounts are signed off, but very much at the point of approval and sign off of the accounts. And really our responsibility to review that going concern position right through to the point of sign off of the audit reports. So I think from your auditors, you're probably going to be getting a few more questions around those forecasts and sort of future finances and the assumptions you're making within your financial projections, latest financial position post year end, not just looking sort of backwards and retrospectively. So I will just finally cover reserves. I've got about 5 minutes to cover this. So obviously, as I've mentioned, a much linked area. How should a trust go about assessing its target level of reserves and disclosing that within the accounts? We've issued some guidance recently to clients, and I'll highlight some of the key points from this, but we can also circulate the fuller document with the follow-up to this webinar today. So just moving into the first slide, obviously reserves really underpinning the financial stability of the trust. You're balancing the sort of the need of today's pupils and also those pupils in the future, and also that trustee responsibility to manage and safeguard the assets of the trust. You need to ensure its future existence and sustainability. So in terms of what are defined as reserves from the point of view of a reserves policy, well, you'd be excluding anything really that is not seen as your operational reserves, your working capital. So this is typically excluding the capital side of things, so your fixed asset funds would be excluded from this, and also the pension liability, the pension reserve, which obviously for most trusts is a negative reserve. So you're really looking at that. Normally that sort of net current asset level, potentially also factoring in any longer term liabilities as well if they're not capital related or pension related. So it's the funds available to meet those short term financial commitments ultimately. The Charity Commission has lots of guidance on this. They define this as free reserves, typically for charities. They would often only consider unrestricted funds, but really for an academy trust here, you're looking at your revenue restricted funds as well, because certainly where you have unspent GAG, for example, it has a broad application across the activities of the trust. ESFA, plenty of guidance also on this, and obviously it falls heavily within the accounts direction as well in terms of what's required for your statutory accounts each year. And really a responsibility of the trustees to set a reserves policy, and as part of that to consider a target level of reserves. So just the final slide from me is really what are some of those practical considerations when you're setting a reserves policy, when trustees, potentially via a finance committee, are looking at this in detail in terms of setting a target level of reserves. So a number of ways that we've seen this, and actually your reserves policy could be a mix of some of these as well. But you could define this as a sort of an absolute target, so a fixed value of reserves. So for example, a single academy trust says they absolutely need a minimum of 500,000 of revenue reserves, operational reserves at any point in time. That might be quite suitable for a single academy trust. Quite popular is defining this in terms of months cover of spend, for example. So for example, you could say that your minimum level of reserves needs to be equivalent to at least 2 months worth of your payroll costs, obviously with staffing costs being a core proportion, a key proportion of your regular spend. And then finally, a percentage basis. So for example, that you want to hold a minimum level of reserves of the equivalent of 5% of your general annual grant that's received each year. Some trusts have a mix, as I said, of all of those, or a couple of those. And really, what is that level? How do you define that level? The ESFA has moved away from giving any defined guidance on what that level should be, but really defines ultimately what trustees should be thinking about in respect of setting that reserves target. So, for example, the risk profile, the working capital requirements, if you have PFI schools, for example, quite high levels of commitment, future commitments there, pensions, payroll, contractual commitments, all of these things being built in to managing your day-to-day working capital requirements, which obviously impact directly on the level of reserves, operational reserves that you need. Factoring in contingencies, so for example, the quality of your estate. Are certain schools in poor repair that maybe means that you might have to have funds for a rainy day, literally, with repairs and things for schools, and the future investment in the trust. So maybe there's not the likelihood of too much emergency work, but you do know that you want to factor in additional funds in the future to invest in ICT, in property and the estate, for example. The other side there is just the demands of ongoing educational provision, maintaining that quality of provision and feeding that into your day-to-day working capital requirements. Just on the related point on the future investment in the trust, really there that some trusts set designated ring-fenced funds if they do know there is future capital investment that's needed. So setting that aside from your core sort of free reserves, your general reserves. For MATs, a number of considerations here. So school level versus central office. So potentially for different schools, primary versus secondary, you may set a different target level. And how do you set the level of reserves target for central office? Reserves pooling, also a key factor for MATs. So whether you fully pool reserves or partially, maybe, so that potentially schools can retain some level of reserves, but a balance is then transferred into the central pot. Sometimes loans between schools are also used here in order to share reserves across the trust to meet demand. And I guess growth of MATs, definitely something to factor in. If you're likely to grow, it brings an increased financial risk, and potentially therefore you need that increased level of reserves. You may want to be upping your reserves target. And just finally there, I've noted the reporting requirements for the annual accounts. So really making sure that the trustees are setting out their policy and the rationale for why you're defining your target level of reserves as you are, comparing that to the actual level of reserves that are held at year end, and really how will the trustees resolve any gaps between the actual and the target level, and remembering to mention any funds in deficit as well, and very much making sure you're noting there how these will be recovered and how you'll correct those out of a deficit, obviously mentioning the pension deficit here, but yeah, very difficult for trusts ultimately to recover that pension deficit. But this is certainly on the operational reserves and deficits at any school level to be mentioned here and in the notes to the accounts. So I will conclude there. I'll now hand over to Stephen. We might have time just for a couple of questions. So over to you, Stephen. Thank you.
Great. Catherine, thanks very much indeed for that, and thank you to Catherine and Hugh as well for a very interesting presentation. We do have a number of questions, so we will follow up, I think, in more detail with answers separately. But if I can just maybe ask Catherine Biscoe a question, if that's all right. There have been a few questions about laptops and the laptops that have come in from government, and how they should be treated in the accounts and what sort of value should be ascribed to those laptops. So I don't know whether, Catherine, you could just give us a brief file on that.
Great, thank you, Stephen. I mean, I'm going to sort of talk through a little bit as what I think the sort of the principles would be there. Obviously, we are sort of awaiting that detailed ESFA guidance, but I think the key thing here is if you have received as a trust laptops from the ESFA, I think obviously their expectation there is that, you know, these are donated assets to the Academy Trust, and therefore you would be recognising those as income in your statement of financial activities. Of course, yes, you would have to sort of ascribe a value to those. So really, you know, if you look at the SORB, thinking about the sort of income recognition criteria there, what is the fair value, or what is the value of those assets to the trust? Of course, there's going to be an element of estimation and judgment needed there. So I guess you want to have that evidence ready as to why you've come up with that value. Then there's, of course, the sort of the passing these laptops on to the pupils. So, you know, as I was referring to, are you sort of giving them away forevermore? In which case, you know, that would be expenditure in your statement of financial activities. Or are you retaining as a trust? You know, you're just lending them, you're retaining the risks and rewards, and therefore it is really an asset of the trust and remains on your balance sheet. Of course, it's not just as simple as that. There were sort of wider considerations, because also laptops were received from maybe local authorities or from sort of third parties. So again, what is the arrangement there? It might not be quite the same as the ESFA's arrangement, where it's a donated asset. It could well be that, you know, the local authority has sort of lent them to you, and therefore or is just passing them through, and therefore possibly it's a sort of an agency arrangement that you're party to as a trust. So there are quite a number of sort of potential nuances to the treatment of laptops. Hopefully that's useful in terms of the sort of the core principles, and I'm sure the ESFA will be giving us a bit more detail shortly when they issue the bulletin. Thank you, Stephen.
Great, many thanks, Catherine. That's really interesting and helpful. We will await further guidance. I think in the interest of time, we are after 10:30 now, so I think we probably ought to wrap up. But what we will do is we'll make sure that we do follow up on the other questions that have been asked, and we will send answers around to all of you shortly. So thank you very much indeed for attending today. Thank you to colleagues from Buzzacott for their very interesting presentations. I've certainly learned a lot this morning, and very much look forward to reading the new Academies non-financial handbook in due course. But for now, thank you for attending. Part 3, featuring special sector guests, is scheduled for next Thursday, the 24th of June, between 2:30 and 3:30. So we will look forward to seeing you there. If you've not signed up already, then I think please do sign up in the usual way. But otherwise, thank you very much for your time this morning.